Okay, so please pay attention and welcome Will Burgess.
Hey guys, how's it going? So hopefully you can all hear me okay. So I do want to say it's an honor to be here, but Andre I think has to work on his way of asking. He basically said, hey Will, I'd love you to speak at this event. I'm like, okay, sounds good. He's like, I really want these people to know what not to do. I'm like, come on. And it's, I do actually take pride in that because I've had a lot of successes, but everyone can go out and say, hey, this is awesome, I drive a Porsche, I'm living the life and doing all this stuff. But there's not too many people that'll come out and say, I have lost $1 million. I've lost a ton of money. I've made more, but I have made mistakes and it has cost me money. So hopefully I can touch on a couple of these things. I put in an interesting project here that Andre helped me with. Actually, it's the one that's right back there. I just put some of these slides here for credibility before and after. It's an apartment building we've got. So we fixed it up, we made it look pretty. These are the sort of things we do. And here's the properties we're gonna be talking about a little bit today. So we've got Warncliffe up there, Browning over there, Ashdale down here, actually all of which Andre has helped me purchase, and we've done different things too. So a little bit more about me. I'm sure that slide was there for a while, but I used to be an air traffic controller, retired at 39. I pretty much figured out that my properties were making enough passive income that meant I didn't have to work anymore. So I took the plunge and I unplugged from the corporate world and just focused on my family and continuing to grow my portfolio. So here's what we're going to be talking about today, and I apologize if I'm going pretty quick because I actually loaded a lot of slides in here and there's a lot of pictures, so I'll be flipping through. If you want to see anything again, at the end of it, I'm glad to send it to Andre or send it to any of you guys so you can go through this. So what we're going to be talking about are traditional investments versus BRRRR method, and then we're going to get into a little bit more detail about what BRRRR is. After that, we're going to talk about different sources of capital, because really what does it matter if you don't have the money to actually execute this stuff? So I'm just going to put a list up, talk briefly about it to give you guys some ideas. Then from there, I'm going to talk about what renovations increase value. This is my own list, my own experience. It's all arbitrary. Different areas have different prices, but still, it'll give you an idea, starting point anyway. And then appraisals, because really, the BRRRR method, none of this will work unless your appraisals come back at what you're hoping or expecting. And then we'll go through the 3 case studies, those 3 buildings I was talking about. So, traditional versus BRRRR. Traditional method of investing in real estate, very simple. Put down 20-25%, you buy the building, and hopefully rent covers the mortgage and expenses. Make a couple extra bucks at the end of the day. Downside is your money's locked in and you're waiting for appreciation. It's slow growth. It's not something you can keep flipping. If you guys have ever heard about the velocity of money, velocity of cash, you want to keep that going if you want to increase your overall cash. Now the BRRRR allows you to speed this up. Still the same concept, 20-25% down, but you're going to have to find a way to come up with the construction costs. So there's a bit more that you're going to need to kick in. As I mentioned, you've got faster growth, you force the appreciation. Picking the right renovations means you increase the value of the building. So it's great. Increase cash flow. By improving the building, you're increasing the rent, thus increasing the cash flow. Now, as well, you're maximizing leverage, because at the end of the day, when you refinance, you're pulling out every penny that's available to you, so that way you can take that cash and use it again. So what is the BRRRR method? It is buy, renovate, rent, refinance, repeat. That's what it stands for. Now, in a lot of these books and courses and everything you see, a lot of them are going to focus on 1, 2 of these methods. The reality is with the BRRRR, every single one of these, you have an opportunity to make money. So I'm going to break it down really quickly. Buy. I'm sure you guys have heard before, if you buy right, you've already made money. And that's true. If you buy a property for $1.5 million and it's worth $1.8, you already have $300,000 of equity built in the deal. So that's a good way to buy. Renovating. This is where we're going to be spending a bit more of our time today. You're going to pick certain renovations to help boost the return. You're going to be forcing the appreciation. And that's really the key to the BRRRR method. Now renting is also important, because if you get more rent, more cash flow, depending on the circumstance, and this is more true in commercial than in regular residential, commercial being 5 units or more, but an increase in rent will increase the property value. And lastly, well, not lastly, but refinancing. That's huge because depending on the length of term, the amortization, the percentage, so on, that's really going to help your numbers. Lower percent, higher cash flow. Longer term, higher cash flow. So all these are going to play a factor. And lastly, repeat. That's pretty self-explanatory. The more you do it, the more money you're going to be able to churn out. So hopefully that's all good so far, because that's really the BRRRR method in a nutshell. And now we're going to talk about a couple of other things. Sources of capital. I've just written down this list so you guys, because some people may or may not identify that you have different ways of accessing money. The first one is plain simple cash savings TFSA. If you have cash in the bank, great, just pull on it. Conventional bank loans now may need good credit. Banks don't always like to give you money, but it is a possibility. You can go out and borrow. You have underperforming stocks, bonds, mutual funds, depending on your comfort level. If you see real estate being a better investment and you're sitting there watching stock values kind of hover around the same thing year after year, then maybe it's time to redirect the use of those funds. Now you've got hard money. Be careful with this one because these are professional lenders. I sort of treat them as the loan sharks of the real estate industry. They're good, they'll help you out in a pinch, they'll come with money, but there's a lot of fees associated with it, so be careful with that one. Private money, friends, family, investors, pretty straightforward. Seller financing. Andre loves this one because almost every deal we do, I say, hey, can we get a VTB on this? One of the first questions I always ask, because if you don't ask, you'll never know. Now, we've got HELOC. This is probably my favorite one. If you own a home and you set it up with a HELOC, as you pay it down, you get access to more capital. You can take that capital, buy an investment property, renovate an investment property, do whatever you like. Home equity refinance. Same concept, but it's static, meaning like you basically take a snapshot at the time, refinance your home to pull out whatever capital you need, but that's it, and you're paying it back. So you have to be able to cover it. We've got partnerships. Oh, sorry, skipped over one. Got business line of credit. Same concept as earlier, conventional bank loans, conventional lines of credit. If you have a business, sometimes you can use that to your advantage. Just be careful of the tax implications of crossing funds. Partnerships, joint ventures. So personally, I'm not a fan of partnerships. I'm not saying they're bad. I've just seen more go south than have gone well. But there is a time and a place for sure. If you are not familiar with construction, for example, and you have a partner that's very familiar, maybe it's a very symbiotic relationship and you can both jump in on the deal. You just have to take it for what it is, but be careful with them. Personally, if I can do it on my own, I'll do it on my own, so I don't have to answer to anyone. If I want to rip out a kitchen, put a new one, I can do it. I don't have to answer to anyone. Last, RSPs. Usually big tax implications, but if it's sitting there again doing nothing, it could be an opportunity for you to grab that money and do something with it. Okay. I apologize again if I'm going pretty quick. So here are some simple upgrades. I call them category 1 upgrades. It's mostly lipstick. You're redoing a kitchen, bathroom, painting, flooring, and the curb appeal. You can see the percentages right there. Obviously, kitchens and bathrooms are highest on the list. I don't think this is really any surprise for anybody, but those will get you the highest returns. Painting is huge because really, what does it cost for a can of paint and to go through a house and paint it for a couple of days? You're getting a 5% return on that, so that's a really good one. Same with flooring, depending on your level of confidence with construction, everything. That can play in. Now, curb appeal, lots of people don't tell you how valuable it is. It's valuable when you're selling a home, but it's actually quite valuable when refinancing or trying to get an appraisal done. I have never had a property do well that didn't have good curb appeal. Every time I've made it look pretty, it's appraised higher. So whatever the appraisers tell you, you just have to take that information. My first world experience is that's what it is.
Sorry,
Now,
Will,
yeah.
What's curb appeal?
Curb appeal, landscaping, making the place look pretty, paint the outside, yeah, that sort of thing. So, now, category 2, these are the bigger ones. So this is actually where you're probably gonna make most of your money, or how you have to start looking at buildings. When you're looking at it, you say to yourself, okay, there's either an unfinished basement or a basement sitting there not doing anything, and we're gonna talk about that with Ashdale. It's one of the first ones. There's duplex, triplex conversion, same concept, but actually you're legalizing different units. That puts it into a whole different category when it comes to selling a property, appraising a property, and everything. Adding a bedroom is a great one because really if you have the layout, it's really just a couple of pieces of 2x4, some drywall and a door. And now you've got a bedroom. And now you've taken your house from being, a 2-bed, 1-bath to a 3-bed, 1-bath. And that bumps it up. And it's really not that costly. But again, all depends on the floor plan, the layout. Adding a bathroom, same sort of thing. And a big one lately is a laneway house or garden suite. Those have gained in popularity because of the rules in the last little while. So it makes perfect sense though, because you're adding an entire other building. What's up?
Yeah, I'm wondering about that because sure, a lot of those have been on the market yet. I know I've heard some stories where buyers are not getting the
Yeah, it is a new product. Now I have seen it increase, but it does depend. So a lot of that is also going to depend on the lender themselves. You have some lenders that are a little bit more avant-garde and they accept that, okay, this is a laneway house, it's adding to the value and they see it. And I'd say you're getting about 60 or 70% of the lenders that are still very conservative and they're like, we don't understand this, so we're not going to count the income, we're not going to count the square footage, and therefore we're just going to appraise you as is. So I think that's going to gain in popularity because as soon as 1 or 2 of the banks accept it, the next ones will be on board because they realize they're missing out on a lending opportunity. They want to deploy their money as much as possible too, right? So. Yeah, but you're 100%, you're right. It's still pretty new. All right, so appraisals. Now this is where the rubber meets the road. All of the work, everything that you do doesn't matter if the property doesn't appraise well. So we've got 3 types of appraisals. Full appraisal, conventional, guys come in, check it out, walk through the house, check the comparables, and they come up with the value. This is still probably the best, most accurate type of appraisal. The next is the drive-by appraisal. This became or gained popularity during COVID because literally they would drive by. They wouldn't go into the house, they trust you to send pictures, and they give conservative values, so I'm not a fan of those. Last is desktop appraisal. I actually like these. So the bank will give you a number. They don't necessarily have to go by, but why I like them is sometimes they've given me a number and I'm happy with it and I've accepted. Other times they say, that sucks, and I forced them to do a full appraisal. So it gave me 2 opportunities to do the appraisal and increase the value. Because once the full appraisal is done, it's really hard to get the bank to change their mind. So if this comes up low, at least you have one more opportunity to hopefully justify the value. All right, getting into case studies here. So this is Ashdale. It was purchased at $795,000 by Andre and myself. And it was purchased as a duplex. Upstairs, we got the 2-bed, 1-bath. Downstairs, 2-bed, 1-bath. Now, the downstairs with 2-bed, 1-bath didn't make much sense because there was a whole basement. So we decided, these are the actual hand drawings. Those weird signs came up on them. Those are the actual hand drawings and we converted it. Those are more professional drawings. And here's what happened. Market rent was $2,600 for a 2-bed, 1-bath. Same thing originally for downstairs, but we never gave it a chance. We converted it to 4 bedrooms, 3 bathrooms, and got $3,900 a month in rent. So by making that conversion, we got an extra $1,300. And in 2024, we actually converted it to an Airbnb and almost doubled the income, or actually more than doubled the income. So that's a strategy, but I'm not going to be talking much about Airbnb today. If you do have questions about it, definitely feel free to come up after and ask me. So this just gives you an idea of some of what we did. That was the space before. That door actually led to nowhere. We had to move the wall back, so that washroom was put in. So you can see now we've got a hallway. We used that space under the stairs for washer dryer. It's a pretty conventional move in Toronto. And all this dead space here, tightened it up, which allowed us to put in another bedroom. So that's how we got the 2 bedrooms, just utilizing that space. Upstairs, we didn't do too much, just paint, made it look pretty. Same with this here. Pictures. And here are the numbers. Yes, by the numbers is intentional. My friend like to make fun of me for. So $795 purchase price, refinanced at $1.2 million. So on the deal, we were able to get all our money back plus an additional $30,000. So it was all in all a successful BRRRR, not only because we got our money back, but also because we remained cash flow positive. It's around $1,100 a month. In addition to that, you'll notice this is a $3,900 for the downstairs. We've since converted that to an Airbnb model, which is around $8,100. So that's going to be closer to $5,000 a month in terms of positive cash flow. You can see in the next slide here. So this happened right around COVID time, and then I'm sure all you are familiar, property prices skyrocketed. So we got a bonus refinance. We saw an opportunity when the prices went up. We just called for another appraisal. Went from 1.2 to 1.6, and we pulled out an extra $305,000 in just a couple of years. So it was a pretty good project. I'd say that one worked out pretty well. And again, the market rents went up, but that doesn't count what we made for Airbnb, so we're still positive cash flow in a pretty healthy state. Everything good so far? Yeah.
The return capital is the objective to pull that out and do another project with it?
Yes. So the last step on the BRRRR method is the repeat part. So as soon as you get it, refinance, you rent, do all that stuff, then you're just doing it again. Take into consideration though, you're only going to be able to do it about 5 times with conventional banking and owning residential properties personally. Once you get there, you're either going to hit a door limit with the banks or a number of property limit with the banks. Then you're going to have to go to either B lenders or go to commercial. The risk is it doesn't appraise for what you want it to, because if it doesn't, your equity or your money gets stuck in the project. That's really the biggest risk. So you have to be confident that when you get into it, you're willing to sacrifice that money. Now we're going to move on to Browning. So this is the second property. This one is a little bit more involved, and I had to definitely eat some humble pie on this one. So I came in a little bit cocky here because I had done some apartment building renovations and things like that, and a fourplex came on the market. It lined up with everything. It was a private sale, there was a VTB, there was even a built-in contract for underpinning. It was too good to be true. So I jumped on it and I'm like, this is gonna be great, it'll be easy. Well, turns out that was in the middle of COVID, and actually Andre and I did a video which is kind of cool because we predicted some of the things, the rise in interest rates, rise in property values, and all came to be true. And this is one of the projects we were trying to make the predictions from, because I was investing, well, really no one was doing anything, and that's why I was able to get this at such a good deal. So the scope of the project, 3rd floor was a studio, weird layout, so we made it into a purpose-built 1-bedroom. You can see market rents versus Airbnb, so just marginally higher here. 2nd floor didn't do anything, main floor didn't do anything, and the basement was the heart of the project here to turn it into a fourplex. So here's the 3rd floor, before and after. We moved the wall, so that's what it looks like today. Same thing here. Walls moved up, everything looks better. And there's the underpinning. So here's where I guess the heart of the project. So the after, everything looks good in the end, but it took a lot of work to get there. For my kids, you kind of see the ceiling height. We're maybe about like maybe 6 feet in areas. So here's a contract that I inherited from the previous tenant. Now this was the underpinning contract, and I thought it was a great deal because at the time it would have cost me 120 grand with the guys on my team. But I know the guys on my team, they're good. So I probably should have stuck with them, but we'll learn more about that. I figured 120 grand versus 54, I got a lot of buffer there, should things go wrong. Well, we'll see how that goes. Not only did the project get delayed, but there were also some other problems along the way. You can even see the deposit check there. So here's what we started with. And a great saying as well too, if it smells like cat pee, it smells like money. So, there I am, sitting in the holes. You can see them marked off, 1, 2, 3, 4. They do the underpinning in stages. They dig down the hole, then they're gonna fill it with cement. That's what it looks like there. They fill it, and now that area is supported, and this area is waiting to be done. Now, for those of you who aren't familiar with underpinning, this starts to be a problem. Getting water underneath. We had a soil engineer take core samples and everything passed, everything looked good. But we started having a problem. And I noticed the problem when we had the dimple board there. I came out and it was bubbled. I'm like, that doesn't look right. Why the hell would the dimple board be bubbling? Well, it turns out the wall of the exterior of the building started to drop. and caused a dimple board to bump. So that was a big indicator. And then we noticed cracks starting to form. That was a lot of fun. And then we went over here. This was not dug out. All the dirt started to fall out from underneath the foundation. Now, did I get a deal on the underpinning? And the reason I picked that there is that lock is attached to the house and that post is just sitting on its own. So the house dropped by that much. So about 3-4 inches. So you can see the cracks start to form. And remember, this is a semi-detached. So we're attached to our neighbors. So this became a big deal. See the cracks going through the house. Couldn't open some of the doors. Had a couple of broken windows. All this happened the same day. I called the guys back and I said, you gotta come here right now. They're like, why? I said, the house is falling. So get your asses back here. It's 5 o'clock. I don't care. We gotta pour. We don't have permission to pour. Well, didn't matter to me if we had permission to pour or not because my concern was the house falling. So I just said, take lots of videos, lots of pictures. We're gonna pour and we'll deal with the city of Toronto later. So that's what we did. By the end of the day, we had all the sections poured, started digging everything out. That's what it looks like afterwards, a couple of days after. And I just had to do some explaining with the city. And that was one of the risks you had to take, right? I could have done nothing and played by the rules and the house could have fallen. But sometimes you just gotta do it. In the meantime, I had to go through, patch, paint, do all the work involved to bring that place back up to par. Nonetheless, we more or less got there. This is what the property looked like on appraisal day. I talked earlier about curb appeal. Yeah, it didn't go too well. So, and the best part is, all the way up there, that's the front door. How the hell do you get there? So, yeah. So here's what happened. On appraisal, yeah. Because we ran out of time. The underpinning company that I hired ran about 2 months late. We said we're ready to go and they showed up 2 months later. We were at the bottom of their list because they were getting paid that much less by honoring a quote that was about 2 years old. So that's what ended up happening. The whole project went behind. This is the actual mortgage. If you remember, we bought it around 1.5. We could only get 950. And we had to get that private. And this is what private money cost. Just the administration fee alone was $28,000.
Sir, I just want to hold the question to the end because we have about 7 minutes left, and I just want to make sure we get through it.
Yeah, the last one I'm gonna blast through pretty quick because it's gonna be for more sophisticated investors that understand cap rates, but we can wrap this one up. So that's the cost, and once we paid that, we had 12 months, so everything was more under control. That's what the front of the house started to look like. In-floor heating. Got all the paving. Once this was done, it was back in our court, and it only took us about a month and a half to finish. So those walls were up within about a week. We even started a deck on the 3rd floor at the same time, because again, these are the people I know and trust, all part of your team. That's huge. We had problems with the city. They said, even though the engineering drawings allowed for a wood beam, they said, nope, pull it out, and they wanted to seal one. So we said, no problem. My guys had it done that afternoon, which is pretty amazing. So as it progresses, drywall stage, Andre and I did a thing upstairs then at the same time while all this was going on downstairs. And then granite, kitchen. So if you remember, this is what it looked like to start. This is where we are now. And this is what it's like furnished. So, should look pretty good. So that was painful. Like it's a lot of money, a lot of heartache to get there for what I considered a simple project, but nonetheless, we did get there. So here are the numbers. This is the first time round. Purchase $1,417,000, refinance at $950. So we had to pony up 820 grand to keep this thing going. Now, it worked to our advantage because one tip I have for you is never use your own capital first. Go and borrow first while you have money in the bank. Banks are way more willing to give you money. Then afterwards, if you need to, you dip into your own capital. But don't use your own capital first and then ask the bank for money because they'll never give it to you. That's just my personal advice. So that's how we had the 820 because we already borrowed to get in it. So even the cash flow is negative because we didn't have any basement income. Thankfully, after a year, we were able to refinance at what it was estimated at. So 2.6 million. So the net return capital is 1.1 million. So we got 300 grand and positive cash flow. So ultimately it was a success, but quite painful to get there. So now we've got about 5 minutes. Okay, I'm gonna move through this quick. So this might be a little bit more advanced because this is what we do with apartment buildings, which is commercial. It's a different animal, but again, talk to me afterwards if you want. Purchase price, $650. This is out in London, that's why it's so cheap. We put in $640, refinanced at $2 million, getting $1.8 million return on a CMHC mortgage. So net profit of $509,000. But you can see the extent of the renovations here. We even put fireplaces in all the apartments for 13 grand. Got engineering costs in excess of 10 grand. So there's a lot of work that happened. If you look at the actual designer architect fees, pretty substantial. But these were the pictures I showed earlier on and the state it's at now. Now some of the rents here were original rents. They're actually almost double nowadays within just the last little bit. So I'm going to explain this really quickly. Are any of you familiar with the cap rate? Yeah? Okay, good. So the gist of it is you have your gross income minus expenses gets you your NOI. And so there's certain cap rates in the area that allow you to basically determine the value of a property. So example, property sold for $1 million. There's a rent, 100 a year, expenses 30,000, NOI of 70,000. Here's how we come up with the cap rate. 70,000 divided by $1 million, get 7%. So why do we care about these cap rates? In commercial real estate, it's generally how prices are dictated. So if we know the cap rate for an area and we know the NOI, then we can determine the price of the property. Now there are published cap rates, so we don't really need to go through this too much, but purchase price $2 million down payment. That's just a breakdown again of how we bought the property, so the capital required. Moving along quick, a couple of minutes. Income is a bit dated, but pay attention to the $14,240 or $170,000 a year. Those are the expenses, $54,000. Now the NOI, so the net operating income. You got your annual income, 170 grand, your expenses, so all the things I showed previously, insurance, so on. This is what I said, I can reference, I can give you this information after because we're going quick. So now all we need is a cap rate. Thankfully, they publish the cap rates and things like CBRE. They'll show for certain areas, they'll show multifamily, high-rise, Class A, Class B, whatever they think, and they'll give you a range as well. Ours was at the top end because it's essentially got renovation, almost a new build, which puts it at a 5% cap rate, which means our NOI being 116,000, valued the property at 2.3 million. So at 2 million, we got a good deal. So even though we did the first one where we constructed the property and we got money out of it, we did a second one with more conventional financing. And then we also found a way to increase value. So I'll leave you guys with this because this is kind of a cool trick. When it comes to commercial properties, any way you can increase the NOI, whether that is a decrease in expenses or an increase in income, adding a washer, dryer, like laundry room, anything. In this particular case, what we did is we offered free internet to our tenants and we actually increased the value of the property by 150 grand. So it's a win-win. And here's how we did it. The internet costs $150 a month to get the highest speed available in the area. We set up a network, cost us around $2,000-3,000, put in some unified systems throughout the building, and this way every one of the tenants had access to internet. Then we increased our rent by $60 on average for a total of $780. So $780 minus $150, $630 a month extra that we're bringing in. Doesn't seem like too much, right? But when you take that $7,560 annually and you divide it by the cap rate, that increased the building value by $151,000. And that's money we can actually go back to the bank and pull from it. So if you add all sorts of little things to increase the NOI of the property, to increase the property, in the commercial world, it's very easy to get money because they all follow a formula. Residential, it's a little bit more arbitrary, but that's what it is. So I believe that's pretty much it. 12 seconds left.
Yeah, that was like down. I was like 12 seconds. Like,
91 slides.
yeah, that's amazing. Thank you so much
No problem.
for that. We have a couple of minutes to take questions. Any questions for Will?
Yeah. So I started off doing all this in 2012 with $25,000. And I bought my first property for 250 grand, 10% down as a first time home buyer, even though it was investment property. So, but I lived there, so to speak. And that got the ball rolling. And as I refinanced things, that money became available to me and I kept the repeat going. So those funds built, but at the same time, the reason I stressed earlier about getting the money in advance from the bank is when you have money sitting in the account, they start throwing in offers. You want a line of credit, you want this, you want that. And I just started saying yes, yes, yes. To the point where you now have hundreds of thousands, if not millions of dollars in lines of credit, credit cards available to you to use. And that makes it that much easier. It certainly does help me sleep a lot better at night, knowing that I could write a check for a whole project. Like, and I don't, like, regardless of where the money comes from, like literal cash in the bank or through lines of credit, just knowing we have that allows you to go into projects in a very confident way. So, long answer, but you build it up over time, but as you build up your bank account, also build up the money that's available for you to borrow.
We'll take one more question then.
Yeah.
I will. Thank you so much for your presentation. So I know I didn't. To kind of get started, a couple, just like maybe 2.5 years back. He used it to the brim. He just went with it and just kept on rapidly scaling stuff. Investors are trying to like keep themselves above all the people who scale too fast using the strategy. And I think I really wanted to ask about, you know, your experience, because it really seems like there's so much I think one of the things that really, you know, demoralized me a little bit, which is like seeing like, wow, you have like $80,000 of leeway of being ahead in the game, and then you can still end up behind and you'll still end up like just barely
Yeah.
a little bit more about your background and like what you thought you came from, being a controller into this. Like, what kind of experience you have before? Like, do you have any construction? Like, how did the ignorance that really play out into this method? And also, like, how did that guide your advice for anyone that's going to pursue?
Well, you need to have the confidence to follow through or really believe that the end game is going to be worth it. Like, so if you believe in the project, believe how it's going to work. I often talk about the fundamentals. Like, when you buy a property, you should see a way that it's going to cash flow positive at the end of the deal. I've never bought a property that doesn't cash flow positive from what I say day one. And day one might be after 6 months of construction, but it always cash flows positive. And I do take into account the variable interest rate if that's the way I go, because I want to leave a bit of a buffer. And that's part of the reason we did Airbnbs is Andre and I had a discussion at the time. We saw that the interest rates were going to rise, and even though I used, we were at 3% at the time, I think I used 7% for all my numbers. I'm like, we might get in trouble here because if it goes past 7, and it was on that trend. Mm-hmm. So we looked at alternatives, and that's why we flipped a lot of the units into Airbnb. So as they became vacant, we just convert them, and then that allowed us to get more cash flow out of the building. So we were able to absorb the higher interest rate spike. So.
Only that aircraft controller experience, or did you have some of your own
No,
experience?
I was fortunate. Like my dad actually did a lot of construction. I didn't even know I could do stuff. Like, until my wife was like, "Hey, we need this done," I would just do it. I'd build a wall or fix the plumbing, and I didn't even know I could do it. I didn't even know it was a thing. So thankfully, my dad taught me a bit. Being an air traffic controller definitely teaches you how to multitask, manage time, deal with projects, like make snap decisions, but well-informed snap decisions. Like, okay, we're gonna pour. Like, we can't be like, you're gonna pour. Like, this is not, there's no question, because the alternatives, and it's just, make the call there and I'll just have to deal with it. So those things certainly do help. I didn't really touch on my other background as well, that I did also start a business when I was younger, when I was 19 years old. It manufactures vinyl records, and it actually, we got some pretty famous artists. We helped them. So Drake was one of our clients, so we helped make him a household name. Nelly Furtado, Sum 41. We also signed Tragically Hip and Rush. So that's a whole different aspect of my life that has to do with business and finance and decisions that I was able to bring to the table with real estate. But even with all that stuff, real estate is where it is. I don't see, like business, I have to actively work at it all the time. Air traffic, I'm trading my time for money. Real estate, I don't have to do it. I set it up and I let it just rake in the money. And in addition to that, if I really don't want to do anything, there's so much real estate worldwide that you can hire property managers and professionals to run it. So if I'm 80, 90 years old and can't do it anymore, I can still hand it off to companies that there's a lot of options and they know what they're doing.
Thank you, Will.
So, yeah.
Awesome. Round of applause for Will, please.